In this video, we'll focus on adjusted basis and we'll go through a problem. Now, before you watch this video, please watch the video that focuses on amount realized as well as the amount realized problem video. Now, before we go into adjusted basis, recall that whenever you have a property transaction, you're dealing with property in the tax law, and property is defined very broadly. It can be tangible, intangible, even a thought in your head, right? Intangible property, boom. Whenever you have property transactions in tax law, Section 1001 is the gateway provision to all property transactions. And it says that you have to calculate the realized gain or loss. The realized gain or loss. And the realized gain or loss, we have to calculate that. You're going to take amount realized minus the adjusted basis. And again, that equals the realized gain or loss. Now, in the video, the amount realized problem video, I go over with you how exactly or why exactly this formula, how it fits together with the rest of the tax system. And again, just to summarize, realized gain or loss goes to the realization element of gross income. Basically, the idea is in gross income, you need three things: accession to wealth, realization, and dominion control. Realization is the idea that you need some type of triggering event. If your property just goes up in value, simply just goes up in value, that is not a triggering event. So realization, there's some event. And here, for realized gain or loss, as it specifically says in Section 1001, with a sale or other disposition. If you want to know why exactly, again, the realization requirement is important, again, watch my previous videos. As I mentioned, we're just going to go right to sale or other disposition. So sale or other disposition focuses on, well, sale is when you convert property for cash. So we just call it selling, right? It's when you convert for cash, property for cash. You can have an exchange, so you're converting property for other property. You can have involuntary conversions, like a hurricane comes, destroys your house, and you get insurance money. Or the city comes and condemns your property or seizes your property for eminent domain to build a highway through it. The key is that it's voluntary, involuntary. Regardless, if you have property, you got to worry about Section 1001, calculating the realized gain or loss. So in this video, we're focusing on the adjusted basis. Again, I have a video that went through amount realized, which is where you should start. Once you go through that amount realized and finish that amount realized concept, now we can go through the adjusted basis. So adjusted basis is actually a very technical term. It's actually a tax item. Okay? There's a lot of things in tax that you'll also see in other areas like accounting or other areas of law, economics, but adjusted basis is a tax item. It's a tax calculation. It's a way that we keep track of something from a tax standpoint. It's what I think of when I think of adjusted basis, and I have a video that goes over adjusted basis. It's a storehouse of unrecovered tax capital. And the idea is we use this running tally we call basis to keep track of the item, usually property, could be other things as well, so that it doesn't get double taxed in our system. And also you can use it for things like depreciation. You don't get double tax benefits. Okay, so it's a storehouse of unrecovered capital. This is kind of the little house. Sorry for my poor drawing. So the question here is asking for the unadjusted basis. Unadjusted basis simply means, if you ever see, okay, you're like wondering, well, what's the difference between adjusted basis and unadjusted basis? Okay, that's a great question. Unadjusted basis is the adjusted basis as soon as you acquire the property, so initially. Because the idea is, in Section 1016, we take the unadjusted basis, UAB, and we subtract away certain adjustments. Or we add certain adjustments. So we might subtract away depreciation, amortization, Section 179 expense, or we might add certain adjustments, like if you improve the property, put on a new roof, or you add a forklift to a truck and you didn't have the forklift before, or you add on a room to a house. That's all increasing the basis, okay? So you're going from unadjusted basis, and then you have your adjustments, and that gives you the adjusted basis. So when you're first learning about calculating basis, when you learn it, you're actually learning about unadjusted basis. And that's why this question asks you for the unadjusted basis. Now again, if you're taking a tax class right now, studying for CPA, the EA exam, bar exam, whatever it is, and it's got tax, and the question asks you just for the adjusted basis, and it's telling you initially when you acquire it, it's the same question. The idea here is I'm telling you, hey, they just acquired this property. What is the unadjusted basis when they first acquire it? That way I'm not making you think about, what kind of depreciation might be taken in the future, those types of things. I'm asking you initially. Initially is the key when you're asked about unadjusted basis. It could be phrased in a different way where it's, hey, what's the basis initially as well? All right, so let's go through this. Let's go through these three situations. But before we do that, again, because adjusted basis is a tax item, we have to talk about some tax rules. So I already mentioned a few code sections, right? We got section 1001, section 1016. One very important code section is section 1011. Section 1011 is a traffic cop, or you could think of it kind of like a stop sign telling you where to go, right? You got stop. It's like a traffic cop. It directs traffic, or a stop sign where it's directing traffic. The idea is that section 1011 says, hey, in determining the adjusted basis or unadjusted basis, you have to look throughout the code. You could go many different directions. And there's infinite, right? Or not, there's not really infinite. I shouldn't say that. I should take that one away. There's many basis rules. If you're taking a tax class right now, you're looking at the CPA exam, you're studying for the EA exam, whatever it is, I guarantee you're learning between 10 and 20, 30, maybe even 40 basis rules. There's so many basis rules out there, and you're learning them. Every non-recognition rule, for example, has a basis rule. You're learning all these different basis rules. So section 1011 is basically saying, hey, you have to look throughout the tax law to find the adjusted basis. You have to look throughout that law to find that adjusted basis. So the main basis rule is found in section 1012. This basis rule is used, I would say, about 80% of all tax property in the universe. And section 1012 says, hey, if you buy or exchange, through the regs, property, you use its cost. So if you purchased a computer for $1,000, when you first acquire it, you spend $1,000, guess what? You've got a $1,000 basis. Now, a few special rules. If you borrow money and you pay with the borrowed money, you still get to add that into the basis. That comes through the Crane and the Tufts decision. That idea, it's not exactly from that decision, but it's the same idea. It's solidified through that in the regs as well. If you take on someone else's property and you take on a liability, that is also included in the adjusted basis. So it's not only just direct cash, it's also constructive cash. So we talked about actual and constructive cash in the amount realized video. Again, if you didn't watch that, please go back and watch it, because again, it's very important. So amount realized, remember, we had actual cash received plus constructive cash received plus the fair market value of non-cash property received and services. And then finally, we subtracted away selling expenses. Well, that constructive cash just means liability relief when you're the seller. Well, what if you take on? So constructive cash paid, which is taking on a liability, gets added into the basis. You get to add that into your basis, the amount you take on. So we'll see that in one of the problems in a moment. But if you pay actual cash, if you borrow money and use those funds to pay, or if you take on someone else's liability, boom, all three of those get added into the basis of the property. All three of those. So that's very, very important, okay? So we got actual cash that we pay, borrowed monies. So if you borrow money from the bank, right? Or if you take on, right, constructive cash paid, either one. You can kind of think of borrowed money and constructive cash kind of similar, right? All of these are paid, what you pay with, okay? In addition to that, and we might not have this in our example, but I'm going to put in any of these examples, but it's still something to understand, and you'll probably see this in later videos I have or other topics in your courses or whatever you're studying. If you also pay with property, if you pay with property in determining the basis, then you can put that property, so if you do an exchange, the idea is if you trade your computer, which is worth $1,000, for someone else's truck worth $1,000, and you can use the fair market value of your property to determine the basis of the other property. That's actually through a case called Philadelphia. Oops, spelled that wrong. I know some of you out there, right? Philadelphia Park and Amusement. Important case from the early years of the tax law, early 1900s. And Philadelphia Park and Amusement stands for two issues. It stands that we can, for amount realized, which again came from the other video, amount realized when the parties are at arm's length, they're not related, the amount realized should equal for both sides. Right? And that's what happened in my example, right? We had a computer worth $1,000 and a truck worth $1,000. They should equal. The idea is economically, you're not going to give up something unless you're going to get something of equal value in your mind. Okay, unless you're related in some way. Okay, that's the first principle of Philadelphia Park and Amusement. The second principle of Philadelphia Park and Amusement is this principle right here. If you are giving up property, here you're giving up a computer worth $1,000. That $1,000 will be the basis in the new property. Now, with that, you might have to recognize gain, because if you're exchanging computer for truck, and let's say your basis in your computer is, it's most likely a loss, right? You probably bought the computer for $1,500. Now it's worth $1,000. It's probably gone down in value. But let's just, unrealistic example. Let's say you bought the computer for $800. It went up in value to $1,000. I don't know, maybe it's antique. Right, like cars. So maybe it's worth something now. It's special computer. So maybe some famous person out there, LeBron James, their personal computer. Okay, so it's got some value, right? Some certain value. Well, you bought it for $800, worth $1,000 now, and you're trading it for a truck worth $1,000. Well, guess what? You'd have a $200 gain. But again, you can still include the fair market value of the exchange property in determining the basis. Interesting, right? But you would have a $200 gain in that situation. Okay, so those are really the main elements when you consider basis. So let's consider A, B, and C. So in A, Grape purchases an unimproved piece of vacant land for $1,500. So thinking about what we have here, what you're paying with, got actual cash, borrowed funds, constructive cash taking on their person's liabilities, and then fair market value of exchange property. We're just determining the unadjusted basis. We're not worried about gain if there's a LeBron James computer truck example, right? So here, we only have one of those. We have actual cash, right? Remember, that's implied actual cash. So the unadjusted basis in A equals $1,500, right? It's just the actual cash. Okay, B. Grape purchased a small rental cottage as an investment, paying $5,000 down and taking the property subject to a 30-year non-recourse mortgage of $45,000. Okay, so you got to think about what's going on here. This is basically what's going on. Grape has $5,000 of cash. Okay, so Grape is paying with two things. Grape is going to get this rental cottage, right? Let's draw the roof there a little bit better. There we go. So Grape is going to get this rental cottage. Grape is paying for the rental cottage two things. $5,000, $5K of actual cash, and also taking the property subject to a 30-year non-recourse mortgage of $45,000. So constructive cash paid, right? Constructive cash, there's a liability on it of $45,000. So that would be constructive cash. We have actual cash and constructive cash. We can add both of those into the basis. So we take the $5,000 actual cash, the $45,000. So we add those together. $5,000 plus $45,000 equals $50,000, and that's the answer for B. The unadjusted basis in B is $50,000. Okay, we got one more to do. C. Grape purchased a vacant piece of land bordering a highway for $2,000, plus $300 for real estate commissions and $30 for title search. Soon after acquisition, he built a jump the gun. He built a roadside produce stand for $1,400 cash. So this one, we've got some interesting things. Let's zoom out a little bit, give ourselves a little more space, because we're going to need some space to draw this. Okay, so what's going on here? And we have to think of the entire transaction. Again, we're focusing on the unadjusted basis. So first things first, Grape purchases a vacant piece of land. We've got land for $2,000. For $2,000. Okay? So we got the $2,000 there, plus $300 for real estate commissions and $30 for title search. So in addition, remember amount realized, remember actual cash received plus constructive cash plus the fair market value of non-cash property and services minus selling expenses. If you are paying selling expenses, guess what? You get to add those in. If you pay those, right? If you pay the closing costs on a home that you buy, you get to add those into your basis. You get to add those in. Same thing here. We've got $300 of selling expenses, real estate commissions, and $30 for title search. So those get added in. Those get added to the basis. So no, you do not get to expense those immediately if you're a business like this case here or an investment. No, you got to add them to the basis because the idea is you subtract away, you add in costs that are needed to get the property to sell because it relates to the transaction. It does not relate to the period at issue. It relates to the actual transaction. So the piece of land is going to benefit this taxpayer over many, many, many years. So the idea is that you're going to put those costs in there. Okay. Before we actually go into the analysis, soon after acquisition, he built a roadside produce stand for $1,400. Ooh, this is interesting. We haven't seen this yet. Because if you think about it, right, and some of you out there are watching this, you might have taken an accounting class before, right? Assets are all economic resources that have future or present value that can benefit the business or the person, the individual, right? And for those of you who have taken accounting classes before or business classes, you know you have to list out all the assets. Cash, accounts receivable, inventory, land, produce stand, right? It's a different type of asset, right? They're different types of asset. We do the same thing for tax. So in this problem, and this is the interesting part, we've got two assets that are materially different. So we have to list them separately. And I'll explain why it makes a big difference in a second. We've got the land, we've got the produce stand. Okay? We've got the land and we've got the produce stand. Two separate assets. We're going to do C down here. Sorry about that. Draw a line. Make it more linear. Okay, the land and the produce stand, right? Two separate assets. In addition to the fact that they provide different economic benefits, right? The land is needed for the produce stand, but the produce stand is actually where customers come. You know, it stores items and, you know, you sell them over the counter and all that good stuff. So it has different economic benefit. Another reason why we have to separate them, and this is specific, many of you will understand this, from a tax standpoint, is because land is not depreciable. We cannot depreciate land. But the produce stand, guess what, is depreciable. Okay? We can depreciate it. So, sorry, should be no depreciation. That's what I meant to say on that. Not depreciation. Sorry about that. So, no depreciation on the land. You're not allowed to take depreciation on land. That's true in financial accounting, tax, because the idea is that land is going to continue to be there, okay? But the produce stand, we do take depreciation. I'm not going to go into depreciation. That's not what this problem is dealing with, but that's important to understand. We have to keep the bases different and separate because you can actually depreciate that basis in the produce stand. Okay, so look at our costs. So, and think about what's going on here. So Grape purchases a vacant piece of land bordering a highway for $2,000 plus $300 real estate commissions and $30 title search. Soon after, guess what? That comes after. So what does that mean? Everything before relates to the land. So for the land, we've got actual cash paid, right? I'll just do it over here on the side. Keep track of it. We got $2,000. We got borrowed money? No. Constructive cash? No. Fair market value of exchange property? No. Any selling expenses? Yes. We've got $300 plus $30. We've got $330 of selling expenses. So we add those two together, and guess what? The basis of the land is $2,330. What about the produce stand? Well, this one's easy. He built the produce stand for $1,400. So costs that go into actually building an item, that would be considered actual cash. Could be borrowed money too if you actually have to borrow the money. That's just going to be the $1,400 amount. Boom. Just like that. And we have our bases. And we've gone through most of the general important ideas when it comes to basis and looking at what goes into basis. All right. So again, the way this works is if you think about our amount realized video, You take the amount realized, you calculate that, right? Actual cash plus constructive cash plus fair market value of non-cash property and services minus selling expenses. Then you subtract away the adjusted basis, and that gives you realized gain or loss, and you've got your realized gain or loss under section 1001. Boom, we've done it. All right, I hope you've enjoyed this video. Please look at my other property transaction videos. Look at my non-recognition video. Very important for a later topic. I hope to see you again in future videos. Thanks a lot.